This is Ralph Sass, and this is the lecture for Financial Accounting, Chapter 2. And once again, this lecture will be broken up into two parts. At least that's my plan at this point. And so let's go ahead and get started. There are three basic financial statements that I mentioned in the first, in Chapter 1. And we're going to talk about these, and we're going to take a look at it from a corporate standpoint. In Chapter 11, we'll take a little bit of a look at how it would look from a sole proprietorship or a partnership perspective. So we will come to that. The only real difference is in the owner's equity section, and we'll talk about that in Chapter 11, the last chapter for the class. The first of the three financial statements is a balance sheet. Sometimes it's called a statement of financial position. And it describes where you stand at a specific date. The way I like to think about a balance sheet is it's a snapshot. It's a picture. This is what the assets, liabilities, and owner's equity of a particular corporation looks like at a particular date, December 31st, perhaps. Did it look that way the day before? No. Did it look like that on January 1st? No. When did it look like that? On December 31st. Very similar to a snapshot. If I take a picture of you right now, that's exactly how you look at this minute. Will you look different in a half an hour? Very possible. Will you look different tomorrow? Very likely. You're going to have different clothes on, what have you. So it's a snapshot. It's a picture of where you stand at a particular date. An income statement, on the other hand, is a movie. It's going to depict what happened to revenue and expenses over some period of time. So it's going to say what's happened to various revenue and expenses, whatever, over some period of time. So I like to think about it as a movie because it's going to have a period of time. And then finally, we have a statement of cash flows, and a statement of cash flows is going to explain what happened to cash during some period of time. So it's going to look at, if you will, one item on the balance sheet and say your balance sheet on December 1st, 2017 was $1,000. On March 31st of 2017, it was $25,000. How did it go from point A to point B? What are all the items that went into cash? What are all the items that came out of cash? And how did it get from point A to point B? A couple of items, revenues, and this is very difficult to understand, result in positive cash flow, and expenses are negative cash flow, either in the past, the present, or the future. And we're going to talk about this more in Chapter 5, but it could have already happened, it could happen in the future, what have you, but it's going to result in a positive cash flow. But just because it's a positive cash flow doesn't mean it's revenue. I can get cash into a business and it not be revenue. When I go borrow money from the bank, that's money that comes into my account, but it's not revenue. When I sell stock to shareholders, that's money that comes into my bank account, but it is not revenue. So just because I have money that comes in doesn't mean it's revenue. And likewise, just because I write a check, just because I have money goes out of that checking account for whatever reason does not mean it's an expense. So we have to be very careful of that, and that really causes introductory accounting students a lot of problems. So when I explain some of that later on, please pay attention. This is an example of a statement of financial position or a balance sheet. Couple of quick notes here as we're getting started. And the first thing is all financial statements need a heading. That heading, the very first item, should tell you the name of the company. So this is Vagabond Travel Agency. It is a statement of financial position, so it's telling you it is a balance sheet, and it will have a particular date. So when was this balance sheet look like this? It looked like this on December 31st, 2015. Assets will generally be on the left. If they're not on the left, it'll be the first items listed if it was a straight line. Liabilities and owner's equity will always be on the right. Okay. Assets are what you own. They are listed in liquidity order. And what that means is the things that can be turned into cash, the easiest, the quickest, what have you, are listed first. Those items that are going to be very difficult to turn into cash are listed last. So cash is obviously the first item here because it is already cash. I disagree a little bit with the way these two are listed. I would have put accounts receivable as number 2 and notes receivable as number 3. Accounts receivable, a little bit of terminology here. Accounts receivable is money that you expect to receive typically from customers. Notes receivable is money that somebody owes you, but usually there's interest attached to a notes receivable. Supplies are things you have in that paper or pencils or what have you, perhaps office equipment, computers, whatever, building and land are pretty self-explanatory. On the right hand side we have liabilities. Once again, liabilities should be put in the order of which they need to be paid. I would argue accounts payable and salaries payable should be 2 and 3, 1 and 2, and this notes payable should be number 3. Accounts payable are amounts that you owe others that they're going to pay you back, or pardon me, you're going to pay them, usually for supplies, inventory, what have you. Salaries payable are going to your employees. Notes payable are usually promissory notes that you've signed, and usually they include interest. You may have notes payable for things like cars, trucks, equipment, what have you. And then the last section down here at the bottom is owner's equity. And there's typically 2 items in owner's equity from a corporate standpoint. One is capital stock, and that's how much you sold the stock for originally. And then retained earnings, which is the total profits and losses that you've earned for as long as you've been in business. Most businesses have, stock companies I should say, have both of those. And we'll come back to talking about those particular items at owner's equity section when on chapter 11. There is the concept of the business entity, and a business entity is separate from the personal affairs of its owner. So if I own the pizza pit and it's my personal car, it does not get included in the pizza pit's financial statements. If, on the other hand, the pizza pit owns the car as a delivery vehicle, it gets included in the pizza pit financial statements, but it would not be on my personal, it would not be my personal asset. Assets, which are on the left-hand side, are resources that are owned by the business. So these are things you own, and I already talked about each of those items. So, and the reason why we own these assets is they're expected to provide us with some benefit to the future. Okay, so those are the things we own. If I was looking at your personal balance sheet, things you own might include your car, your clothing, maybe if you own a house, your house, your furniture, things like that would be the assets. Those are things you own. Okay. Some assumptions we use when taking a look at our assets. First off, and probably the most important, is the cost principle. What we're going to want to look for is a receipt. How much did you pay for it? If you paid 20 grand for it and you have a receipt for 20 grand for it, what's going to go on the balance sheet? 20 grand. If, however, the list price of that car is 25 grand and you were able to buy it for 20, you were a great negotiator and got it for 20, can you put that 25 grand on the balance sheet? And the answer is no. What goes on the balance sheet? The 20 grand that you paid for it. That is the cost principle. Stable dollar assumption. We are not going to account for inflation. If you've got something on the balance sheet and you put it on the balance sheet for $10,000, you bought some gold, and it's on the balance sheet for 10 grand, and the price of gold doubles up to 20 grand. Can you go ahead and mark that up to 20 grand? And the answer is no. It's got to stay on for whatever you paid for, whatever that cost was. The objectivity principle. We're not going to go based upon your assumption for its worth. I got a great deal. The car was worth 25 grand. I got it for 20. I don't care. What's it going to go on the balance sheet for? Cost principle, 20 grand. That's objective. And finally, we're going to assume that you're a going concern. Your business is going to continue to be in business. There are some accounting procedures that are followed in the event you decide to close the business down, whatever, and they're way beyond the scope of this class. So we're going to assume that you're going to stay in business. The other side of the balance sheet includes liabilities, and liabilities are debts, people that you owe money to, okay? and they represent negative cash flows in the future because you're going to have to pay those amounts back. So that's money you owe. Okay, go back to my example of your personal car. Suppose you own that Honda and it's worth 10 grand. Okay, that's your asset. It's 10 grand. You might owe the bank still 5 grand on it. So what's your liability? It's 5 grand. And then your owner's equity is what's left, the residual, the owner's claim to those assets. Going back to my example of your car, you own the car for 10 grand, you owe the bank 5. What is your equity in that particular car? Well, your equity in that particular car is 5 grand. Your assets must, and this is an accounting equation, and it must equal your liabilities plus owner's equity. If it doesn't equal, you did something wrong. Okay, so your accounting equation, your assets have to equal your liabilities plus your owner's equity. And basically that's saying is what you own, you either owe somebody for it or it's part of your equity. It's part of your residual, what's left to you as the owner. So let's take a couple of quick looks at some transactions here, and just to kind of get us get us started here. Notice he and his family invested 80 grand in the business and received 8,000 shares at $10 per share. Keep in mind our assets always have to equal our liabilities, and they don't have liabilities here, but it would be up here if they did. Notice our assets are 80 grand, our liabilities are 0, and our owner's equity is 80 grand. Okay, so that's what's going on. Quick note, this is not going to be revenue. Okay, it's not going to be revenue. We'll talk about that over the next couple of chapters, but just because they got cash, in this case, it's not revenue. They purchased some land from the city for 52 grand. Notice, since they bought it, their cash is going to go down by 52 grand and their land is going to go up by 52 grand. And notice, most important than anything, their assets still equal their liabilities plus owner's equity. Keep in mind at this point, obviously they don't have any liability yet, but our accounting equation is still holding. They purchased an old garage. Okay, they purchased the garage for 36 grand. They put $6,000 in cash and they owe another 30 grand. Okay, notice what happens. Now the building comes on for 36. Okay, since I paid 6 grand in cash, my asset cash was 28 grand. Okay, it was 28,000, and now it's going to be 22. So it went down by 6 grand. And notice my note payable is 30 grand. My note payable is 30 grand. Notice my total assets are now up to 110. My total liabilities are still 110, and my assets still equal my liabilities plus my owner's equity. Note, I have not yet had any revenue, and I have not yet had any expenses. They purchased some tools and equipment, 13,800 on account. Okay, so I bought some tools and equipment. Those become an asset, 13,800. My total assets go up by 13,800. I have accounts payable here of 13,800. I owe somebody some money on it. My total liabilities plus owner's equity goes up by 13,800. Quick note, I would have put those items in opposite order. Accounts payable, because it would need to be paid first, should go, in my opinion, above the notes payable. I purchased too much, so I sold them to somebody else. Okay, now I have an accounts receivable of $1,800. Why? Because they owe me the money. Notice my tools and equipment went down by $1,800. Why? Because I no longer have 13,800 in tools, but I only have 12,000. Note that my total assets didn't change. Notice my total liabilities didn't change, so it's still 123,800. And notice this particular transaction just impacted the asset portion. Sometimes we will have transactions that will just impact one portion of the balance sheet. Okay, it doesn't necessarily mean that you have to impact both sides of the balance sheet. Now, they paid overnight $600 as partial settlement of its account. So what happened is their cash went up by 600, their accounts receivable went down by 1200. Whenever you receive cash, cash is going to go up. Okay? Notice once again, assets didn't change, liabilities and owner's equity didn't change. I am going to stop here and we will pick it up here with the second part of the lecture on chapter 2 in the second part of the lecture.